Bitcoin's one of those things. It's complex enough that you all like, no matter how long you've researched it, you always are still learning about it. But the more I learn about it, the more bullish I get. Um, and at the same time, I kind of view it as the only realistic method to change some of our monetary aspects. So one of the big themes in the book is kind of like technological determinism, which is that things kind of had to turn out this way, at least for this time period, just due to the kind of the order of technologies that emerged and that naturally would emerge, but we're kind of stuck in this local maximum of money, where transaction speeds are very fast, but settlement speeds of anything scarce like gold have been very slow. And so we've kind of had a century and a half of necessary abstraction, and that's easy to centralize and control and leverage. And Bitcoin is the first and really only credible way to break out of that. So while I'm never 100% sure on any asset, there's all sorts of challenges and frictions that can happen. But if it's not Bitcoin, I don't really know what else it would be. So I think that's how I'd phrase that.
In October 2023, Bitcoin remained steady around $28,000, but altcoins felt selling pressure due to surging crude oil prices driven by the Israel-Hamas conflict. Adding to the crypto drama, traditional finance saw 10-year Treasury yields reach 16-year highs, impacting the crypto rally. The upcoming week brings critical macroeconomic data. The U.S. will reveal September's Consumer Price Index (CPI) and Producer Price Index (PPI), while the Federal Reserve releases September meeting minutes with various Fed officials giving speeches. Investors trade cautiously as the Fed eyes another rate hike in 2023. Bloomberg's expert Mike McGlone spots a risk-off trend in Bitcoin, partially due to the oil price surge causing liquidity concerns. Despite hurdles, Bitcoin saw its largest outflow from exchanges in a month with over 10,000 BTC moved. Breaking $28,000 remains vital, given the low number of distinct addresses. In the U.S., the crypto scene is on the verge of transformation. The potential approval of spot Bitcoin exchange-traded funds, ETFs, could be a game-changer. This regulatory shift could open the door for financial institutions to invest in Bitcoin comfortably. Estimates suggest that up to $17.7 trillion could flow into Bitcoin if these ETFs get the green light. It's a sign of growing acceptance of Bitcoin within traditional finance. This development could enhance trust in Bitcoin, paving the way for more institutional investment in cryptocurrencies. As we step into the final quarter of the year, Bitcoin is poised for a potential bull run. Historical trends show that the token has broken above its monthly descending trend line, a positive sign. While retracements are possible, experts believe Bitcoin could reach highs near $100,000. Additionally, Bitcoin is entering a pre-halving phase historically associated with significant price increases. The crypto world may be on the cusp of another major bull run as the recovery phase takes hold. In summary, Bitcoin faces geopolitical challenges and market volatility, but its resilience and potential for a bull run remains strong, fueled by macroeconomic factors and growing institutional interest. Let's continue our discussion with Lyn Alden.
There are technologies, and sometimes there are things that we think of as basic today, like running water, for example, or refrigeration, where you just have to show people it exists and then they want it, right? You don't have to convince them. You don't have to force them to get it. It's just engineers can sometimes make something so good that it permanently solves a problem almost for everyone over time as it becomes more and more accessible. And that's something that, politicians can't really do. And, any sort of like ideas and things like that, or governance structures and things like that, they're inherently these temporary local phenomena, right? So some countries, if they're governed well, are going to do better than other countries for that epoch, like that period of time. But technology can just change things globally, and then that change is permanent. Like we have refrigeration, and more people have access to it, almost everybody now. And that's just a permanent part of the human experience now. And I kind of view the same thing as money, like applying to money, which is that when certain things happened, it changed how we interact with money, sometimes for better, sometimes for worse, because you can actually, in some ways, have a technology that has consequences to it. And so it's one of those things where I think a lot of the criticisms of central banks and monetary kind of governance in general, while I agree with a lot of them, when we look around and we see that it's happening literally everywhere, that's not like a coincidence. That's basically it's been a technological limitation that moved incentives in that direction. So the way I describe it in the book, there's 160 different fiat currencies. Some of them are pegged to the dollar, but a lot of, pegs can break. And a lot of the other ones are free floating. And so you have all these little currency bubbles, and you ask, why is it like this? Why isn't, out of 200 countries, why isn't one on a gold standard? Or why isn't one kind of doing free banking, right? The fact that every single country pretty much, at least any country of scale that's not just like, say, using the dollar or something, but every country of scale does things this general way. And I think that's basically there's been a technological reason for that. And unless or until you have wide usability of fast settlement, which is with Bitcoin being the first credible way to do that, and so far the most liquid, most decentralized, most immutable way of doing that, then that problem doesn't really solve it. So I think instead of just complaining about the Fed or complaining about the system and kind of like waiting for it to blow up and then trying to protect yourself, I think this is like the era where if Bitcoin's going to succeed, it's got to be built. And people have to go out and build that parallel system. And if you're successful, and it's like refrigeration, where you don't have to convince people to want refrigeration, it's just obvious. Bitcoin just has to be better than the alternatives, and that's what makes it win. So the Federal Reserve tightening is putting a lot of downward pressure on certain industries, but so far it's only certain industries. So it's basically entities that have debt that is rather short duration and has to be refinanced. And so the question is, who is that group? So it's commercial real estate, it's junk rated companies, and then it's generally small businesses that rely more on bank financing than bond financing, right? So those are the groups that have generally been more negatively impacted by the Fed's tightening efforts. On the other hand, if you locked in long duration debt with a mortgage, or your corporation was 30-year bonds, they're relatively protected from these rising rates. And in some cases, they're actually benefiting from them. So for example, if you were Apple and you have about as much cash as you have debt, but the debt is locked in with long duration interest rates, and then the cash pile is variable, and you're holding a lot of T-bills and you're kind of making a lot of money, then the higher interest rates actually stimulate companies that are more cash rich, as well as if you're a wealthy retiree that has a home with a low fixed mortgage attached to it to kind of short the currency, and then you're holding large amounts of cash and money markets and things like that, you're doing quite well in this environment. So on one hand, the ongoing deficit spending, especially from the interest side, but also just from the whole deficit spending, is very stimulative. And the Fed tightening is damaging to certain areas of the economy. And so I kind of viewed it as this kind of intermediate period where for some people it already feels like a recession, and other people are saying this is great. And I think that we're in a more industry-specific type of environment because of these unusual forces. And I think it can potentially persist as long as the reverse repo facility still has funds in it, because that's largely what has allowed for this fiscal expansion to occur while the Fed remains tight. I think the environment changes once we get to a point where the Fed is no longer able to remain tight, because you get that oversupply of treasuries flooding the market. But right now, the reverse repo facility represents kind of the last kind of area of money that can easily go into treasuries.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.